Hello,
Awesome.
hello, Baltimore world, Facebook world, social media world. My name is Josh Shine. I am on with Jessica Franta, who's head of our capital markets and investor relations department at Trias Lending Partners. I'm the CEO of Trias Lending Partners. We come to you today on a live stream on a bunch of different social media platforms just to check in, give an update on the broader real estate market in the Mid-Atlantic, the greater sort of Maryland region, and just to check in and give some updates and hopefully answer some questions. We'd reached out in our promotion of this event and asked for some questions. So we have some questions that people have teed up for us already. If you have additional questions live as we're going through this, please feel free to just drop it in the chat in any of the social media platforms. We're monitoring everywhere where we're streaming this live. So if you ask a question, no bad question, no stupid question, no wrong question, we will absolutely make every effort we can to answer the question before we are done for the day. So I guess I'll start out with just a basic sort of overview as to where things are right now. I'll start off in the sort of greater Baltimore region based on what's going on. In the last week or so, last 10 days, there's been a little bit of news in the Baltimore region with the DSCR loans having some tightened up regulations and requirements, getting a little more difficult to do. A number of different national lenders who do these DSCR. These are the rental loans. Okay, these are the long-term 30-year rental loans. So a number of the companies that close and fund and service these 30-year rental loans in the greater Baltimore region have done one of two things. A number of them have either paused their lending in the Baltimore City and Baltimore County market, or they've just really tightened up some of the lending parameters, meaning they've gone to a higher property value, higher loan amount, meaning a bit of a better quality property. Okay. And they've also adjusted the loan to values as well. So that's a big change as well. This was a bit of a breaking news type story within the industry. It certainly impacts a lot of investors. As a private lender, our focus is giving everyone short-term loans. And what myself, Jessica, Steve Sless, the rest of the team, what we all do is work with people on short-term loans to renovate the property and then either flip it or refinance it if they're holding for rental. So these loans being a little more difficult is a bit of a challenge for the marketplace. Having said that, a few sort of asterisks I want to bring up if you've experienced that or gotten some news of that. Number one, there are some lenders still lending here, okay, in these DSCR loans. So it is not true if anyone tells you that every lender who's doing the 30-year DSCR investor rental loans in Baltimore has backed out. They have not. There are people doing it. There are just a lot less people doing it. Number two, bank options and traditional loan options still exist. They always did exist. They always will exist. The change is, or the challenge is that the DSCR only loan is a little more challenging to get. The DSCR only loan has to do with simply the debt service coverage ratio being sufficient to cover the mortgage, principal, interest, taxes, and insurance. So if you're a good credit borrower with strong income, strong assets, and some experience with a good property that brings in good rent and has a good loan to value. Now, as I'm saying that, I'm saying to myself, and Jess, I don't know if you're thinking this too, like everything I just said is pretty much common sense what you should be if you're a real estate investor, right? Like,
Right. Yeah.
right. Right. I mean, I'm hoping you're not like
And
if you
no, in
have
the
bad
back of my
credit.
head, I'm like,
Yeah.
not much change in a lot of regards. Really the fundamentals actually remain exactly that, the fundamentals, right? If you're a good borrower that had great credit income, and also we've underwritten the property correctly, and you have a safe, solid loan to value, to your point,
Right.
Josh, the debt service coverage, still will very much be in place. Yeah.
So you'll still be able to, and you can right now, still get those loans done. So I want to be clear, there's still options to get that done. It still works out there. We, as a private hard money lender who are doing the rehab loans, the acquisition loans, the short-term 6, 9, and 12-month loans, we're still lending. Period. End of
Mhm.
story. That's probably the biggest question as recently as an hour ago on a phone call with a friend in the industry locally. He said, "Are you still lending? Are you still lending?" We are absolutely still lending. We still believe in this market, both short-term and long-term. He asked me, how long do you think this will go on for as far as this sort of pause or challenging environment for these DSCR loans? I said, look, it's anyone's guess. You have no idea how long it's going to be. If you have a loan that you were thinking about getting into a long-term loan, I would probably move pretty quickly with the people that are still doing them and try to get those loans done as quickly as possible. Feel free to reach out to us. We're happy to introduce you to some of the players and partners that are doing that still in the marketplace. And or reach out to traditional bank, and those are options as well for a traditional full doc, as we call it. Full doc meaning full documentation, full underwrite, your income, your assets, your experience, the whole bit. It's not just credit score. They're going to look at everything, and it's logical. Okay, it just makes sense. So
Mhm.
it's not. It shouldn't be seen as the end of the world. How long will it go on for? My guess, and this is just literally a roll of the dice, just a complete guess out of thin air. My guess is we'll probably have this for most of the rest of 2025, certainly for the rest of the summer, there's no doubt about it. I'm thinking in the fall into the winter, certainly no later than January, most of this has resolved itself. But supposedly the word is there was one person who went bad on a lot of loans, one individual, and that's really where it comes from. It doesn't come from the market being a bad market. It's not a bad market. It doesn't come from housing being a bad investment. It's not a bad investment. The story is, and this has been verified by a number of people, one large person with hundreds and hundreds of loans went bad, meaning defaulted on hundreds and hundreds of loans in the greater Baltimore City and Baltimore County area. As a result, the buyers of these loans are saying, hey, let's slow down and be a little more careful and a little more deliberate in the kind of loans we do. How does this affect what we do at Trias Lending Partners? So, what it does for us is just cause us to be safe as we always have been, careful as we always have been. Would I say we're probably a little safer and more careful? Yeah, we are, right? I mean, so we're triple, quadruple checking the values, the property, the quality of the borrower. Again, ability to make payments, ability to have a good credit score, good credit history. Do you have a job and income that supports your ability to have our loan and then to have some exit strategy to then get out of that loan? And that's really what this is all about, is everything in life, I would argue, has to do with, when it comes to finances, car, house, so much in life, in credit cards, your ability to spend and buy things and live life, regardless of how you view debt and credit cards. But having good credit, good income, and savings is always the name of the game. And if there's one lesson I could give to anyone young, starting out, or having issues and looking to fix it, that's the one thing you want to fix. To the
I
market
guess.
itself, yeah, Jess, jump in.
Okay. Oh, no, we were headed to the same place. So, because I think it's really interesting, if maybe a little bit anecdotal, what is occurring in Baltimore, right? To your point, it's really highly concentrated, and even further, maybe the distress that occurred was even highly concentrated on one particular individual. So it's easy to take maybe one particular instance and then try to apply it across this broad spectrum. But to your point, it's specific really to Baltimore. And then, of course,
Right.
moreover, we're a mid-Atlantic lender. We have a presence. So I
Yeah.
was going to ask you kind of, if you zoom out,
Yeah.
Josh, what your thoughts are as it relates to
Yeah.
Maryland, the greater mid-Atlantic, and greater market conditions.
So that's great. And that's exactly where I wanted to take this. Thanks, Jess. I mean, it's we do a lot more than just Baltimore. So we're the entire state of Maryland. We're doing the large chunk of Pennsylvania, really in the larger areas. We don't do rural loans, generally speaking. So Philly, Harrisburg, Pittsburgh, so those larger metropolitan areas and the surrounding counties within those areas that are close enough to it, where there's sort of a higher degree of population, DC, all of Virginia, and then we'll dabble into the Carolinas, Tennessee, Georgia, and Florida, really case by case, really carefully, really sort of slowly dipping our toe into some of those newer areas. But in our core market, which is that Virginia, DC, Maryland, and PA, and Delaware as well, by the way, we're doing great business there. The market continues to be good. The numbers are good. I'm not going to say great. I specifically didn't use that word because, listen, we're not in an environment of extremely low interest rates. That's a fact. Okay. We'll get to
Mhm.
interest rates in a minute. We're not in an environment where the appreciation in home values is going up 5, 10, 15, 20%, right? So there is activity out there. Inventory continues to be low. That is a story that has been going on for many years. Most experts agree that story will continue on for many years. So, not a lot of places on the market. There's a little more than there was. So, things are sitting a little bit longer. Okay. Higher price are going a little faster than the lower prices, right? So, four or
Mhm.
500 and above are a little more in demand, I would say, than some of the lower dollar points in the broader market. Adjust those numbers for where you go. In DC, you can't get anything for 400,000, but in Baltimore, you
I mean,
can.
a cardboard
Uh,
box. You might get a cardboard
yeah,
box,
right,
sure, yeah.
exactly.
But yeah.
I mean, but like Richmond, Virginia, Virginia Beach, we're dealing in those areas too. There's business
Mhm.
down there, there's activity down there, there are real estate investors buying properties down there, and ultimately holding those properties for a hold or a flip. and selling it to a retail end buyer, a homeowner, right? So that's still going on in the
Hmm.
marketplace. So people still are looking for places to live where they can have a yard. Okay, we don't do sort of large multifamily buildings or apartment buildings or large condo buildings. Okay, our thesis, our theory is that we believe that most people want to be in townhouses or small homes, whether it's a purchase they're buying from someone who was fixing it and flipping it, or fixing it and holding it, that they like those kinds of rentals. So we really don't get into that marketplace where there's, 100 properties in this one tower or building. So we think that people want yards, want some more space, and want something that they can really stretch out in a little bit more. So those are the kinds of properties that we find ourselves financing most of the time. And those places are still in demand. Rents are pretty
Hmm.
strong in the dollars and cents. The vacancies, again, they're vacant because people are looking for places. Those trends in sort of that work-life balance and where the young people are going, that's a story that continues to come up again as well. There's some debate as to where it ends, and are we, I guess, close to the end or not, right? So if you ask someone in Manhattan, they're going to say, okay, in Manhattan, there's definitely still people going back into the office at a higher rate than I think a lot of other cities, right? So in the greater Baltimore region, there's not as much of that. DC is sort of a mixed bag from what I gather. Some places are getting empty buildings, and it's a challenge with some of those government cuts as well, which, by the way,
Hmm.
haven't been as dramatic yet as most predicted and projected they would get. So it's been
Hmm.
impactful, but it hasn't, there was stories of mayhem and the end of the world and the sky is falling. That has not come out to be a reality in the greater DC, and Baltimore gets impacted by that market too, right? A lot of our borrowers work for the federal government, okay, and work in industries supporting the federal government. And as much as you may be reading the news, and there's definitely issues, I'm not saying there aren't, but it hasn't been like this exodus of millions of people being without a job and having to move or find something else to do. So far, the market has absorbed large chunks of it. And I think with all the back and forth, I don't want to get into the legalese, I don't want to get into politics at all, but some of the back and forth, not all of it has come to fruition as it was initially sort of headlined from the press
Right.
release and or the news or whoever. So it wasn't like 50,000 people got laid off, tomorrow. Some of them had packages, some of them had different deals. So as a result,
Right.
the market still seems to be pretty good as well. Now, interest rates is a story that continues to come up over and over again. Where are interest rates going? Most people believe that the Fed will lower rates in the near term. They obviously there's some discussion as to whether they should have already done it or not. I'm not touching that one. I'm no expert. I'm not anywhere near the brain capacity of those people. But I will say that most people believe that rates have, well, first of all, they have ticked down a little bit. So if you look at the 10-year Treasury yield, they have ticked down a little bit. And most people believe that for the remainder of the year, they will stay and or drop a little bit, with the addition as well of the Fed reducing rates. Again, these are all speculations, right? None of this is carved in stone. Too many factors can change. Economics, tariffs, inflation, all of those levers get impacted with regards to rates, and rates get impacted with regards to how those are impacting the broader economy nationally and certainly in our region as well. But when you talk to most people, everyone says, what, I think rates will be a little bit better down the road. For a home, you're talking under 7% generally for a 30-year fixed right now. For an investment property, you're into the sevens generally, mid to high sevens for the investment property loans on the 30-year transactions. Okay. For us, we're at a much higher rate for the short-term financing. We're in the low teens. That's where our rates end up for short-term financing. But again, those are only 3, 6, 9, and 12-month loans. So most people think that rates will get a little bit better. And so, not that not being able to refi into the 30-year fix is good right now if it's a little more challenging, but if it causes a little bit of delay and it ends up resulting in maybe refinancing into a lower rate in 3, 6, 7 months, that might not be the end of the world either. So I'm curious, how that's all going to play out within sort of the broader economy. But when we look at the market and step back, we just did a full out of office day with the leadership team, just sort of going over the marketplace and the business trends. And we all feel good about the business, good about the market. The banks are
Hmm.
still challenging. And that is a headline that really affects, I think, the broader marketplace nationally, but certainly in our region as well. Banks are not crazy about lending. They're still gun shy. Jess and I were talking this morning. Banks are taking a lot of stuff, putting it on the books, leaving it on the books. They
Yeah.
may or may not be telling all of their investors or in all of their disclosures how many loans they're taking back, commercial, residential, et cetera. So they don't want to take on a lot of new loans. That presents opportunity for us as a private lender to be able to be there. And we are getting more calls than ever for people who are frustrated with the banks and want to get their deal done because they're still long-term investors. And that's the other headline piece of this story, I think, is long-term always pays off. Period.
Hmm.
Always, always. Long-term real estate always pays off. Period. End of story. It is always, always a matter only of when, not if. Okay. It will happen. Will it be 1 year, 2 years, 3 years, 5 years, 10 years when you make money on that real estate project, real estate development, real estate investment property? So if you're a true long-term investor, you do still like the market. And quite frankly, when there's a little bit of challenges or rates are a little more challenging or some of the financing gets a little more challenging, that's when some of the real bigger players, more serious players, and more long-term minded players get off of the sidelines and say, you know what? I think this is a time to buy. I think I want to get in now because I think this might be a good opportunity to get in. I'm not going to call it a bottom, but get in when there's really a more upswing to go down the road when rates change, when they drop, when the economy maybe gets out of this level of uncertainty. What say you, Jess? What's your opinion on some of this?
A couple things. I think it's really interesting just listening, and I feel the same way. A lot of these discussions are just really it's headline, 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 and I think that it grabs everybody's attention. It's interesting. It gets the news, but if you actually kind of step back to your point, things have actually been still pretty steady, right? And as you know, anybody that kind of knows a little bit about my backstory, obviously, I personally invest. I had been a borrower with Trias Lending Partners, and I can speak anecdotally that the past couple years, you'd always had tailwinds at your back. So you'd had favorable interest rates, to Josh's point. You'd had the ability to have a reasonable expectation of appreciation. Like some of these generic conditions have deteriorated, but I would say going back to literally how we opened this, in such a way that honestly, as long as your fundamentals remain consistent and steady and you have a great loan to value, you have great underwriting, it's actually the same as it ever was. And moreover, I think the value of real estate, the long term, the buy and hold, that it remains fundamental, it remains the same, and it's very much really what we love. And moreover, especially about the Mid Atlantic market. So for all the headlines out there, honestly, in my opinion, there aren't really that many that are incredibly meaningful. It's really making sense of the noise, and then of course, moreover, personally, professionally, in a business sense, making sure that you're incredibly well positioned moving forward. Yeah.
I think, and no, that's great, and I agree on all of that. I think when you think about the rental market, which is really where a lot of our people are financing. When I first started doing private loans 8 some odd years ago, we were seeing people that are mostly flipping properties, and this has been a conversation and topic that's come up many times. That the transition, because of increased costs of materials, certainly post COVID,
That is
increased
very true.
delays, right? Increased
Property taxes,
delays.
insurance, they have
Taxes,
been,
insurance.
yes.
So everything has gotten killed.
Mhm.
So you're saying, you know what? I'm not going to make much profit or margin, at least not what I was going to make pre-COVID, certainly, on that flip. So let me just hold it. And the
Right.
idea was there's a housing shortage and that
Hmm.
needs to be fixed. Well, the housing shortage was sort of on its way to be fixed, but then interest rates went up and banks sort of shut the gates a little bit. So that housing shortage is sort of back to being a major issue. That's bringing
Yeah.
rents around to be strong. Rents in the Mid-Atlantic, I pulled some data up before our meeting here. I mean, rent prices in the Mid-Atlantic are projected to grow 3.3%. The rents themselves, okay, on an annual base, 3.3%. Not on fire, but not too bad, right? And
Strong.
vacancies
Yeah.
are supposed to continue to be down. So rents are going up, vacancies are going down. People still need that place to live. And the greater mid-Atlantic, which we've always loved as a marketplace, doesn't have those crazy highs and crazy lows of some of the big cities. It has proximity to DC, Philly, New York, big cities doing a lot of different business. And even in the greater Baltimore region as well, I would say Philly as well. tons of technology, tons of medical, hospital, and universities, and those
Mhm.
support a lot of jobs as well. So it's not just a federal government story, there's so much more to it as well. And that's where this has always been a great place to invest in real estate, the sort of broader mid-Atlantic. And affordability is the last part of it, right? So
Right.
pulling DC out, which I always sort of pull DC out. DC is its own separate sort of subculture world, right? And I would say DC is similar in that sense to any of the top big cities. But we like to focus on, and where Trias Lending's expertise has really been profitable and beneficial for us and our investors, is secondary and tertiary markets, right? Those marketplaces that are a little further down the ladder there, that aren't maybe the top place for the coolest, greatest new properties and buildings and towers and real estate. So it doesn't see doubles and triplings of values. And it also doesn't see a starting home price of $1 million, right? You can
Right.
buy a place, Richmond, Virginia Beach, greater Baltimore region, some of the places in Western Maryland. We've done some deals in Havre de Grace, certainly Harrisburg, Pittsburgh, the suburbs of Pittsburgh, certain suburbs in Philly. Philly can get expensive too. But you can buy a starter home for $300,000-400,000 and have a home to live in. Like that's amazing. You talk to anyone on the West Coast, Jess is on the West Coast. You talk to me on the West Coast, they're like $400,000. You can't get a shack on the
Did
West
I tell
Coast,
you this
right? I mean,
statistic? They expect by 2030 the median home price in Seattle to be $1 million by the year
right,
2030, medium of 1 million. So that brings, I'm curious if I was to ask you
right,
what part of the market or what excites you the most as kind of looking forward, because we talk so much I mean, we even opened this conversation kind of in almost
yeah,
a defensive position. Hey, this is, some news headlines. This is what's gone wrong. This is
yeah,
like where we
yeah,
need to make sure we're really safe and conservative and steady. But there is a flip side to this story, which is there's where there is risk, because there's always opportunity. So I guess my question to you, Josh, is where do you
yeah,
think this
yeah.
opportunity
I,
exists, right?
broadly speaking, that's another question someone had left for us before too. Broadly speaking, opportunity. This is, these, I don't want to say downtime, it's not a downtime, but sometimes more challenging or maybe bumpier times, bumpier situations bring about opportunities. If you talk to
Mhm.
people who were able to survive '07 and '08 and then ride out 9, 10, 11, and 12, they had a phenomenal outcome and ROI on their real estate, period. And
Mhm.
I'm not saying it's easy. I'm not saying it's quick. I'm not saying it's not without challenges and not without having opportunity and availability of funds to pay for that. But if you do have some dry powder, if you do have some cash, if you have availability of funds or the income to support it, I think it's an incredible time to get into real estate, an incredible time to buy properties, buy investment properties for the long term. You have to have that long term outlook. Jess, you and I talk about this a lot. Long game, right? Like, I mean, really
Right.
long game. You have to be able to afford to ride it out and mentally be able to ride it out. I think the mental is
Yes.
almost as hard or maybe harder sometimes than the financial side. Like you're gonna go being a real estate landlord investor is not easy. That's like the
It
old
can be
story,
death
right?
by a
Everyone thinks
thousand
it's
cuts.
easy. Yeah, you're
Yeah,
you're
death by
just
a thousand
getting the
cuts.
you're
Mhm.
getting kicked when you're down and then you're getting kicked
Yeah.
and stepped on. It just never ends. It's not all roses and millions of dollars at the end of the rainbow. It's a grind, right? And that's why a lot of people start it and try it, and a lot of them don't stick with it. They end up investing with Jessica and with us in our fund to get a good return because
Yeah.
they don't want to do the real estate part. But if you can survive long term, though, there's nothing better,
Yeah.
right? The stock
Yeah.
markets, the ups and downs, investing in a small business, investing in an entrepreneur, investing in a startup, those have tremendously high risk ranges. A bar, a restaurant, forget it. Like those numbers are crazy. Sticking with real estate always works. But can you buy a property now in July of 2025? And can you say, I'm going to push on this, work on this, but my goal is not to like get rich in the next 2 years or 3 years
Right.
or 5 years.
Yeah.
My goal is in 2035 to be cash flowing really nicely and have paid some of my mortgage down 10 years into it and then keep on trucking. And then in
Mhm.
30 years, that dream, and sometimes takes 30 years, 30-year mortgages is the term I'm using. Maybe you're able to pay down your mortgage sooner, which would be great. But if you just go the 30-year traditional mortgage, so 30 years, can you
Mhm.
ride out 30 years? Jess and I run into people who are in their 60s and 70s and some in their 80s who did and have held on to real estate for 20, 30, or 40 years. And you can imagine their balance sheets, their income, their real estate owned schedule. We call it the REO schedule, right? Your real estate owned schedule is amazing. And we'll look at it and we'll look at it if we're doing loans for some of these people because they still like to leverage and borrow because that's an efficient way to grow their businesses and continue to invest. We'll look and be like, oh my gosh, this is amazing. And
Mhm.
we have great relationships with our borrowers and our investors. We'll talk to borrowers, how did you get to have, you know, 26 rentals free and clear? The answer is like just slow and steady wins the race, right? I didn't try to time it. And that's
Mhm.
really what the story is here, right? Timing
That
for
is
down,
it.
timing for up. Just get in when you're ready, when you can afford it mentally and physically and financially. Just get in. Don't stop. Don't wait. Don't hesitate. Don't try to time it thinking, oh, I'm waiting. When rates drop, that's when I want to jump in. When the next report comes out from the Fed, that's when I want to jump in. When Trump's tariffs are figured out, that's when I want to jump in. When the next Congress comes in, don't get messed up with all that long term. And so we talk to these people and they're like, kept buying, I kept investing. I kept the tenants in there. I did good quality properties. I paid my bills on time, and I just slowly wrote it out. They did not get rich quick. It is not a get rich quick scheme. Never has been, never will be, period. And if that's what you're going into the wrong business. That's a big mistake. But the ones who do well with it, and Jess, you're an investor with your husband. I have properties. A
Mhm.
lot of us in the company do. Um, Slow and steady wins the race. And that's, I think, the lesson. What's your take on it?
100%. I mean, that's it. I think if there was one takeaway from today, again, you open with this kind of crazy bombastic headline, Baltimore and this borrower defaults on stuff and what's happening to greater lending. But really, when you just, and then we kind of zoomed out and then we zoom out further and we zoom out further, it's a long-term game. It's a long-term hold. Yes, you absolutely have to endure, but it is proven. And I just don't think there's better value out there. And it's just the way to go. And it's what we believe in. I think as a company, both personally, professionally, to your point. So really steady on, and
Yeah,
yeah.
the standards always apply, right? And we'll end with this in
Mhm.
another minute or two. And please, if you have questions, feel free to shoot them out. But we will be ending on time at 12:30. But slow and steady, have a plan, and hard work grind it
Mhm.
out, right? That's all it is, and that's what we always tell people.
Mhm.
Not timing it, not trying to think it's easy, right? And so take the time to do the homework. Take the time to talk to one of our experts or an expert you might be working with on your own and try to understand, how do I get into this? How do I start? How do I grow? How do I scale? How do I borrow more? How much can I afford to borrow? That's a big question. How many contractors do I know? Do I know good contractors? Am I learning about the market, the places, the areas, the streets, the neighborhoods, right? Am I an absentee owner or a hands-on owner where I know what's happening, right? All of those are the keys to success. And it's funny, when rates were 3.5%, I was saying the same thing because I'm a long-term
Yeah.
eternal optimist on real estate, on investing, and on taking the slow and steady approach because it never fails. Period, guaranteed. This isn't a gamble. This isn't a going to the casino. This is guaranteed. It's just a matter of time and putting in the hard work and sticking with it. So, on that note, it's 12:29. We want to respect everyone's time.
Yeah.
Thanks so much for joining us. I think we were going to throw up our email somewhere, but either way, it's
Thanks for.
info,
Mhm.
info at triuslending.com. Yes, quick pitch on investing with us.
Yeah. Hey, if you don't want to answer phone calls about toilets or broken sewer pipes in the middle of the night, which by the way, I got one of those calls literally yesterday, so I can speak to that very recently. But honestly, we offer our everything we just talked about today, the value, the safety, the conservative, the experience, all of that. That is also what we offer our investors. We pay our investors on average 10% per year, paid out monthly. It is safe, it is stable, and you get to talk to me. There's no, it's
Yep.
a straight shot. We take, our relationships and our customer service very, very seriously. And I'm always here to support. I'm always here to answer questions and always happy to do so. Yeah.
Jess and her team, total rock stars, incredible service, incredible attention to detail. We do great by our investors, never missed a payment, nor had a principal be impacted in 22 years of taking people's money and giving it out then to borrowers who we lend it to. So it's a great win-win on both sides. If you want to
Yep.
borrow, To learn more about borrowing, investing in real estate, or investing with Trias, please reach out to us, info@triaslending.com. Thanks for taking the time. We hope to see you again soon. Happy to answer any questions anytime about anything real estate and investment related. Thanks for tuning in. See you soon. Bye bye.
See ya.